Why has the interest rate increased so much? Is it a crash coming? How will it impact the real estate market? Sharon Colon, your favorite Miami real estate agent here with Home Miami Realtors. So if you have been in the real estate market, you must wonder what this sudden hike in interest rate is, right? I will share a graph with you at the end that will wave off all your worries, so watch until the end. Now, let's get started. I want to start by saying that I'm not a financial advisor or an economic expert, right? However, the information I'm going to share in this video is about public data, facts, and recent articles from experts I wanted to put together for you, okay? I wanted to make that clear. So let's start with this quote from a real estate expert I heard a few days ago on a Facebook Live. Change leads to uncertainty, uncertainty leads to fear, and fear leads to paralysis. This is the most honest thing I've heard for a long time. Look, all the fears in the industry right now are nothing but rooted in fear of uncertainty and change, right? Because many people don't understand the change, they start panicking and spreading more panic in the air. First, you must understand why the Feds raised the interest rate so much. The Feds are currently riding an unforeseeable wave of inflation, and the stakes are very high. If they don't take prompt actions, we will likely see adverse effects. But if they spike the rate too high, the whole economy can be substantially weakened. Thus, the Feds are targeting a short-term rate hike for a long-term stability. This is called a soft landing, which the Feds are, trying to achieve. Now, how will this reflect? Well, the U.S. Treasury and mortgage rates have already braved the storm and reflect the hike in interest. As a result, consumer buying power is reduced as borrowing money has become more expensive. It all depends on how much this interest hike from the Feds can curb inflation, of course. But let me share facts with you. This is the Market Confidence Index survey by the National Association of Realtors. Check out the median days on the market, which is, remarkable. According to this report, only 16 days, where it was 17 days previous May. The same is the case with the percent of homes sold in less than a month. Just a single digit difference from last year, of course, not that much. But what really reflects today's market and fear is the percentage of first-time home buyers, which is way less, 27% the past month to 31% last year. This is also reflected in the number of offers received on each sale, which is 4.2 offers in May, but was 5.5 in April. Another thing that the report shows is that 24% of buyers waived the appraisal contingency, down from 26% a month ago and 28% a year ago. These numbers are an excellent way to gauge and understand the confusion and fear about the future and how the spike in interest rate has affected the market confidence. The rise in inventory will also get the buyers to get, level playing field. Let me walk you into 2019 or before 2020, when the summertime usually experiences a slight dip in the real estate market as people splurge on other activities. But after 2020, real estate has been the prime focus for a couple of years, right? We know that. And now, when borders have opened up and people have started to travel, we're experiencing the same decline and not a crash. Remember that, okay? We're seeing a market neutralizing or going back to what it was before 2020. So this is more of a similar cycle to what we experienced in 2020. Here are the graphs that only prove what I say, that the pandemic or, prior 2020 had boosted the industry for a couple of years. And just look at where we were in the pre-pandemic times. The surge has to come to a rest, right? With things coming back to normal now. Have a look at the existing home sales. The recent data may result in numbers very similar before 2020. It's actually forecasted that sales stays very similar to before 2020. Also, there's always a decline in mortgage rate history after each recession. 6% might seem a lot, but it's not the 8% average nationwide we have experienced, and nevertheless, the higher numbers hike we experienced in other years. How will this interest spike affect the real estate market? Well, with the rise in interest, mortgage rates have become more expensive. We know that. This results in a decline in buying power that slumps the housing market, making buyers go below the asking price. Property values and housing prices are directly related to mortgage rates, right? But we often forget that these factors heavily depend on our economy. Could they have done anything differently? What is your take on the current situation? Let me know in the comment section. I would love to read your comments below. Take a look at what Danielle Hale, chief economist of Realtor.com, says about the current situation. The housing market is at a turning point. We are starting to see signs of a new direction, but the ball is still in sellers' courts in most housing markets. Experts don't believe the market is in a bubble or a crash is in the cards, like during the Great Recession. The nation is still suffering from a housing shortage that has reached crisis proportions at a time when many millennials are reaching the age when they start to consider homeownership. That's likely to keep prices high. To add to the previous quote, Realtor.com's newly updated 2022 forecast predicts inventory will grow double digits over 2022 and offer buyers a better than expected chance to find a home. This should at least calm the nerve of many, as now the supply chain problems have been resolved and now you will see more houses going to be listed. Buyers will have more options and it will be a healthy competition, to say the least. Time for the all-important question. Should you buy a house? Should I buy a house, Sharon? Well, the answer really depends, right? If you're starting a family, if you want to live the American dream, let's say, if you finally have enough in the bank to buy and live in your house that you dream about, or maybe you're renting and you recently saw the huge spike in rent prices, right? Then it's a definite yes. You should be looking for a home and their current condition might even favor you. On the other hand, if you want to buy a house as an investor, keep it for a couple of months or a year and then make a profit, then my answer is not. It's not the time for you. So it's a no for the investors, but a yes for everyone who wants to move in and live in their new home and stop paying rent. Here's the graph I mentioned at the start of why a recession doesn't equal a housing crash. In this graph, you can see what the last 6 recessions look like. The home price changed during those last 6 recessions. You know, it's important to understand history proves an economic slowdown doesn't equal a housing crisis. While a recession could have an impact in our housing market, does not equal a housing crisis. For example, as you can see in this graph, 4 of the last 6 recessions, home prices actually appreciated. Prices fell in the other 2, minimally in the early 90s and then by nearly 20% during the housing crash in 2008. Today's housing market is nothing like it was in 2008. Hopefully you realize now that a recession doesn't always equal a housing crash, but some buyers have run out of the market and now there is less competition. Let's keep an eye on all the housing market indicators and of course with what experts are currently seeing. I hope you liked the video and data that I provided. If you found it informative and helpful, please let me know in the comments section below. Thank you for watching and remember to be nice and be kind. See you next time.